I'm Darius McDermott, Managing Director of Chelsea Financial Services, and I'm delighted today to be joined by Jim Leaviss, Manager of the M&G Global Macro Bond Fund. Jim, thanks very much.
Hi.
As the title of the fund suggests, it's a global macro, so you have to have a view on the macro environment. Could you share with us your current thinking with particular thoughts around whether or not we may be heading into recession?
I think it's quite clear that there's a global slowdown going on, and the trigger for that really is the fact that we're in these trade wars. So you look at China, you look at the impact of Brexit on growth here, and you see manufacturing recessions popping up all over the world, whether it's Germany, who also have some specific problems around their auto sector and diesels and so forth. But everywhere you look, manufacturing probably is already in recession. There's a great deal of uncertainty in the world, and it's almost that uncertainty that is likely to lead to a further growth slowdown. So yes, I think for the major economic blocks, you couldn't rule out.
So it's clearly a slowing phase with respect to GDP growth.
Definitely, and we've already had negative quarters of growth in areas like the UK, like Germany, and in certain sectors around the world you're seeing significant slowdowns too. So it's not unreasonable for global bond markets to be pricing in more QE from the European Central Bank, rate cuts from the Fed, rate cuts from the Bank of England, more unusual policies in Asia as well. So the bond market has been right to forecast this slowdown. The question is now, will it be as aggressive as the bond market's priced in with negative yields in lots of countries?
Well, that leads me nicely into my next question. With negative yields on 13 trillion, or a third of the global bond market, how then do you as a bond manager actually make some money in this environment? And I spotted that you have a German government bond in your top 10 position. So tell us a little bit about how you actually make money with negative yields as your sort of starting pace.
Yeah, I mean, it sounds ridiculous, doesn't it? I'm buying an asset that's kind of guaranteed to lose me some money every year. Yeah. And you do have to hold your nose to some extent and say, actually, we're not just betting that that's the only way that you're going to get a return out of these things. The way you're going to get a return out of German government bonds, and the fact that those yields have come down and down, gone negative and more negative, remember that's produced a big capital gain for the investors. The reason that's happening is because people are expecting the European Central Bank to step in and start doing more quantitative easing. So in September this year, they're likely to announce another round of QE. So when you've got this non-price sensitive buyer out there buying and printing money to buy, then that's a reason there's someone out there who's willing to pay any amount of money just to kind of try and stimulate the economy, and that's the reason that you can buy these things with negative yields and still make, look this year, very strong positive returns from the asset class. But I agree, it sounds nuts.
Yeah, and where else in the fund, what other positioning have you got in the fund that you think might give us a positive return over the periods ahead?
I think if you look at all the bond asset classes, it's hard to see huge amounts of value in government bonds for the reasons we just talked about. You may make a little bit as a result of capital appreciation. Corporate bonds we do have in the portfolio, and I think there are certain areas and sectors where you still get yields that overcompensate you for the risks that you take. And again, the European Central Bank's going to come in and buy these things again, and maybe other central banks in the future. I think the areas that we should be looking at when you try and find absolute value now, though, are probably emerging markets. Where else can you get yields of 7, 8, 9% in dollar or euro or sterling bonds issued by emerging markets? And I think some of the fundamentals are looking more attractive for emerging market debt, but still lots of landmines. We saw over the summer Argentina get into big difficulties, bond price halves. So it's not without its risks, but if you're looking for absolute value, I'm thinking that's an area I should have more of in the portfolio over the next year or so. It may not be quite time yet, but in a world of zero yields, I think improving fundamentals in EMD, emerging market debt, probably makes some sense.
And you've been managing this fund since launch. I think it's almost 20 years old. What have been the sort of highs and lows of investing in bond markets for you over that period?
Well, yeah, 20 years. 1999, remember, was the year that the euro came into existence. So suddenly we had an explosion of debt issuance. There was no European corporate bond market back then. Now it's one of the biggest in the world. Lots of great opportunities, and investors have done very well out of European bonds as their yields have fallen and that market's developed. So that's been one big thing. I guess the biggest thing, and for many people watching this as well, will be the great financial crisis. You know, the global financial crisis in 08-09 was a game changer for bond markets. It introduced the idea of quantitative easing, of negative interest rates. I remember back doing road shows around the UK at the time, planned before all these banks started going bust. I remember literally being outside, getting off the bus on the way to another venue, being on my phone, trying to move money out of a bank that I thought might be bust at the end of the day. And it was, you know, the most scary time in financial markets. And that threw up lots of great opportunities afterwards. You know, credit repriced to levels that was ridiculous, pricing in a never-ending depression, really, whereas we thought that the policy response was enough for growth to come back. So for me, you know, that was the chance. You could buy BBB rated corporate bonds for yields of 10, 12, 15% in sterling or euros, and you know, those were the opportunities you remember over that period.
Jim, thank you very much.
Thanks very much.
For more information on the M&G Global Macro Bond Fund, please visit chelseafs.co.uk.